Well, I think the thing that I'm most impressed with, I mean, the comments that you've made that have been made by you and your guest have been very good in terms of understanding what's happening. I think the thing I'd add is that, credit metrics were very good in the quarter. I've only seen J.P. Morgan. I haven't seen the other ones, but I suspect they're all going to follow. So credit remains very good, which is obviously something that's good for the banks and good for the economy as a whole. Yield on assets are rising, which is important because obviously that's going to improve their net revenues long term. Net interest income was up 10% year over year, which is, again, your revenue's growing pretty good. I think the other thing is the return on equity is about 14% for J.P. Morgan, and about the return on assets is 120 basis points, which is well above what people thought they were going to be able to do in 2011 and 12 after all this regulation. So they are earning a tremendous amount more than what people thought. I think the challenge is being able to grow loans. Again, I think, as your guest said, they've got about $1.4 trillion of deposits and only about $1 trillion of loans. So there's a lot of room there to grow loans the next, decade or so, which will be able to add to earnings. So the other thing I'd mention is they've got about 32 million mobile customers, and that's growing about 12 or 15%. So when you talk about moving into the new economy and away from the physical asset, I mean, they're growing their electronic business pretty rapidly.
In overall, are the things dictating what you do now, are they macro or just individual fundamentals for you now? Like, how does trade play and all that? Yeah.
Well, I think the stocks have been very highly correlated to the movement in the 10-year, and we've seen that pretty much for about a year now. I can pretty much tell you what the stocks are doing if you tell me what the 10-year is doing. I think the question now is how much more is the Fed going to move? I think they're going to go up. They're going to move 4 more times. That gets the prime to 6%, gets the short end to about 3%. And then you've got some real value in the deposit franchise, meaning the incremental cost of funds will not be 3%. Their margins will be able to expand because it will take time for the assets to get up to that rate. So they're going to have margins expanding for a couple years now, if not for another 3 years, as the yield on assets catches up with the movement of the prime rate. And so that's really the story here, is getting rates up another 100 basis points. I don't think they'll go beyond that. And then if we get to that point where the Fed stops, then we can really start to see the economy, continue to grow, because the fear of the rise in rates will be behind us.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.